Okay, so something really big is happening right now just under the surface of the financial world. It's a story about intense pressure, some really clever loopholes, and a huge migration of risk that's kind of changing who lends money and, who gets left holding the bag.
So, here's the mystery we're diving into. You've got these two corners of the finance world, liability management and specialty finance, and they are suddenly just booming. Now, these aren't names you hear every day, but their growth is a huge signal that something fundamental is changing. So the big question is, why now? Why are these complicated markets taking off, and what does it tell us about where credit is heading? To figure this out, we have to follow two main clues. And our first clue? It leads us right into the high-stakes world of private equity, where some very powerful firms are facing a very serious problem with the companies they own.
And here's the heart of that problem. Private equity firms, what we call PE sponsors, are finding it incredibly hard to sell their investments. The usual ways they cash out, selling a company to another one or taking it public with an IPO, those options have just slowed to a crawl. They are basically stuck holding on to these companies for way longer than they ever planned.
And the situation is getting pretty dicey. A lot of these companies were bought back in 2021 when money was cheap and they were loaded up with debt. Well, now that debt is coming due and interest rates are way higher. On top of that, some of these companies actually need fresh cash just to keep growing. With no easy way to sell, you can feel the pressure on these PE sponsors just building and building. So, what do you do when you're stuck between a rock and a hard place? Well, you get creative. And in finance, creative often means turning to a strategy that's, let's say, a little controversial, but also increasingly popular. And that strategy is called liability management. So what is it? In simple terms, it's a way for a company to bring in new lenders who get to cut to the front of the repayment line, jumping ahead of all the company's existing lenders. It's a really bold move, and it all works by finding loopholes in old loan contracts.
So how do they pull this off? Well, first, some very sharp credit managers dig through the original loan documents and find weaknesses, places where the protections for the original lenders just aren't tight enough. Then, they structure a deal for new money to come in, but with one critical condition. This new debt gets paid back first. It's a move called priming the original lenders. The company gets the cash it's desperate for, but man, it comes at a price, often with interest rates in the mid-teens.
This quote here just nails the shift in thinking. What was once seen as this super hostile, aggressive tactic is now just an effective tool. PE firms are looking at this as one of the only ways to keep their companies going, which is exactly why these kinds of deals are set to accelerate through 2025. Okay, so that's one half of the story. But at the exact same time, there's a totally different drama playing out in the world of traditional banking. This is our second clue, and it's all about a major regulatory squeeze. You see, while private equity is getting more aggressive, banks are being pushed to do the complete opposite. A new wave of global banking rules is putting a ton of pressure on them to de-risk and get certain assets off their balance sheets, and fast. And the main driver behind all this is a set of regulations known as the Basel III Endgame. The whole point is to make the global banking system safer. And it does that by forcing banks to hold way more of their own capital as a safety cushion against any potential losses on the loans and assets they own. So here's what that actually means for banks. Under these new rules, just holding certain types of assets suddenly becomes a lot more expensive because it ties up more of their own capital. This creates this incredibly powerful incentive for them to find a way to get those riskier assets off their books. And, just like in nature, when a vacuum is created, something always rushes in to fill it. As these traditional banks start pulling back, a whole new breed of non-bank lenders and financiers is stepping up to grab a massive opportunity. And the scale of this opportunity is, well, it's just staggering. We're talking about a US consumer debt market, not even including mortgages, of nearly $5 trillion. As banks get more and more constrained, it's these specialty finance funds that are jumping in to provide that capital. So you've got this new dynamic emerging. On one side, you have the traditional banks, who are boxed in by regulations and trying to get rid of risk. And on the other side, you've got specialty finance, which is stepping right into that gap, taking on the very risk the banks want to avoid, all in exchange for a higher return. And one of the key tools making this all happen is something called the significant risk transfer, or SRT. Basically, think of it like this. A bank pays a specialty finance fund to take on the risk that a big pool of its loans might go bad. The bank gets that risk off its books, which frees up its capital, and the fund gets paid for taking on the risk. It's a win-win that's fueling huge growth in this market.
So now we have our two clues. We've got pressured private equity firms looking for aggressive financing, and we've got regulated banks trying to offload risk. So let's connect the dots and see the big picture that's starting to emerge.
When you put it all together, the story becomes crystal clear. You have this huge demand for creative, higher risk capital coming from the private equity world, which is being met by these liability management deals. And at the exact same time, you have this huge supply of risk being shed by the traditional banking system, which is being soaked up by specialty finance. These two trends aren't separate, they're actually feeding each other.
And this right here, this is the single most important takeaway. What we are all witnessing is a fundamental shift. Financial risk isn't just disappearing, it's moving. It's migrating away from the highly visible, heavily regulated public banking system and into the less transparent, more flexible world of private credit. This is the great credit shift of 2025.
So this whole transformation leaves us with a really critical question for the future. As all this risk moves out of the traditional banks and into new hands, are these private markets truly better equipped to handle it? Or are we just shifting the problem into the shadows where it's harder to see? Honestly, that's the question that's going to define the next chapter of finance.